In a valuation process, the valuer will view property returns against alternative investments returns. If an investor is requiring a certain target rate from the property, then there is a relationship between the three variables: initial return, target rate and growth. For example, if an investor accepts an initial return of 5%, but requires a target rate of 7%, bond rate of 4% plus 3% risk, then the income must grow by 2%, g, over the year for the 7% return to be reached. This growth is equal to the difference between the target rate, E, and the initial return, K, assuming that the income grows annually. To conclude, in this case, an investor accepting an initial return of 5% would require 2% growth in income on average each year to achieve the target rate of 7%. This does not mean that this scenario would actually happen, it's just an indication of the pattern that is required if the investor is to buy the investment property at that price. If the actual future growth is lower than this average figure, then the investor has paid too much for the property. If growth turns out to be above 2%, then the investor will achieve a target return of above 7%. This relationship is illustrated in the equation K equals G minus E, where G is the growth, K is the initial return or capitulation rate, E is the target rate. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions. Implicit valuation and explicit valuation of property as a growth investment. Implicit or capitalization valuation. For the purpose of the implicit valuation, it is assumed that rentals will remain at current levels and accounts for future growth by using the low initial yield. Annual net fixed income is €10,000. YP in perpetuity at 5% is equal to 20. The capital value is equal to €200,000. Explicit valuation or discounted cash flow. If the growth at 2% was allowed for explicitly in the cash flow, then the valuation discounts these projected incomes at the target yield of 7%. In the explicit model, the valuation has been cut off at year 10 by allowing for a sale at that point. The calculation could have been for up to 100 years and each cash flow discounted back, the same capital value would have resulted. Yield equation. The relationship between the target rate and the initial yield can be viewed as a balancing act. As the expectation of growth increases, it makes the investment seem more attractive, and this growth increases the risk in the investment. This can be illustrated in an equation. We can adapt the equation, K equals G minus E, to break down E into its component parts, namely the bond rate or risk-free rate plus risk, E equals RFR plus R. The equation therefore becomes K equals RFR plus R minus G. Yield balance. Yield balance is the graphical presentation of the relationship between the initial yield and target rate. For example, referring to the growth investment example illustrated in video 3, we had an investor accepting an initial yield of 5% on the property investment. Consider that yet the initial yield on the bond investment was 6% instead of 4%. Why would an investor accept a lower return on the riskier property investment than he could achieve on the secure bond investment? The reason is simple. The return on the bond will always be 6%, but with the property investment, the investor is expecting for the income, and therefore the capital value, to increase over time. Whilst the investor may only achieve 5% initially, every time the rent increases, so will the return for that year relative to the initial purchase price. The investor is accepting a lower return today in expectation of future higher returns. The difference between the required return and the accepted initial return represents the expected growth. Thus, the process is, relate the investment to a risk-free investment to derive a risk-free rate, RFR. Add to the risk-free rate, a risk premium to reflect the additional risk attributed to that investment, this is the target rate, E. Reduce the target rate by the expected annual growth rate, G, expected to affect the cash flow. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.